Welcome back to another episode of TradesTalk. I'm here today with my co-host Justin, and we actually made a joke that June is going to be financial month on the TradesTalk podcast because all of our guests this month happen to fall within the financial world. Justin, who do we got today?
All right, today we are queuing up Matt Garrett with TGG Accounting. Actually, met Matt about 6 years ago at a CEO peer group retreat and have been following him ever since. Super excited to finally get him on the podcast. He's been a guest that I've been looking for a while. He just is very smart when it comes to numbers, but he's not a financial guy. He's an entrepreneur, and we dig into that, which I really love.
Yeah, he understands numbers really, really well. I think I got both personal and professional advice from Matt. He's just like got this quiet confidence. He understands things well. He has his methods. He works the plan. And you don't see him as, this loud, very in your face type entrepreneur. He's just got this subtle, quiet confidence.
Exactly. Yeah, and he shares a lot of different takeaways, right? We cover the whole spectrum. We cover everything from personal financial investments and creating a system for your personal financial investments, all the way to cash management in your business. And he doesn't just give advice on the fly. Like he does, but you can tell he's a polished speaker, and he has these things like, here are my 3 rules for personal financials. Here are my 3 cash management rules for managing cash in your business. Here are my 3 ways to invest outside of my business. So I just felt like these things are so applicable. They're easy to understand, easy to digest.
Yeah, I agree. And I'm going to take some of them back to, my young team that I have just getting their feet wet in the financial world. I don't own a business. And so, these things don't apply to me as much from the business standpoint, but I'm definitely going to take this back as a teacher and a mentor to my young sales team. So, well, should we dive in and let Matt take it away?
Yeah, and before we do, if you do like what you hear from Matt, you're interested in reaching out to his firm, TGG Accounting, I highly recommend it. They offer everything from staff accountant to controller to CFO services. Their purpose is just helping make business owners' lives easier and giving them clear financial data. So if you want to get a hold of Matt, his company's TGG Accounting, that's Tango Golf Golf. It's tgg-accounting.com. Or Matt even gave us his email, so I'll give that out right now. It's matt.garrett@tgg-accounting.com. You can find him on LinkedIn. You can Google TGG Accounting. You'll find him. But just wanted to plug that. These guests give us so much value, so much content. They do it for free. We do it for free. This is just a passion project. So before we jump in, one last thing is, if you aren't subscribed, you're not going to get any notifications when we drop new episodes. We're dropping every 2 weeks during summer because it's so busy for everyone. Make sure you hit that subscribe button. And if you are enjoying our episodes, just give us a share it to your friends, your family, maybe throw it on social if you feel like it. But we just appreciate all you guys listening in. And without further ado,
That means a lot to us for sure.
let's jump in. Yeah.
It's a passion project, and not to interrupt you there, Justin, but we really enjoy doing it. So you guys sharing it along keeps it going. So let's go ahead and dive into Matt.
All right, guys, welcome back. Another episode of Trades Talk queuing up right now. Today, we got a special guest with us, Matt Garrett, who's the executive chairman and founder of TGG Accounting. We're going to be diving into a bunch of financial discussions today. Super excited for it. Matt, welcome to the podcast.
Thank you. Very happy to be here.
So, Matt, for our listeners, why don't we just start out giving us a little background of who you are, what your background is, and what got you here today?
Yeah, no, absolutely. It's funny. I run an accounting firm, but I'm not an accountant and don't have an accounting degree, and I'm not a CPA. So it's a little strange.
What you're saying is you don't know your way around a spreadsheet.
I'm saying there are people a lot better than me at a spreadsheet for sure. I can read them, not so much create them. No, I'm an entrepreneur by background. I haven't had a boss since I graduated college. I started my first company while I was in college as a .com that I sold in 99. I started a consulting firm that I sold in 05. Since then, have realized that from 01 to 05, I think I fired 7 bookkeepers because I realized they needed good numbers really badly and could not get them from bookkeepers. They just didn't know what, like, they can pay bills, and the best ones are really organized and on time and all that. But, I remember a time when I was like looking at my financial statement, someone to my bookkeeper, I'm like, why do we have negative AR? he was like, well, I put it all into QuickBooks, right? And so I realized that was actually a really big need. And that's how I started TGG, was I thought, we've got to figure out how to be able to deliver good financial information to businesses like the ones that I had built, which were small businesses, 5 to 100 million in revenue, and figure out how they could get good information on time and accurately. So we started doing that almost 20 years ago now, in 2000. I guess we really started it in earnest in 2007.
And that's such a huge need, especially as you go small businesses in general, but you move into the trades where you have plumbers and HVAC technicians and landscape companies. I feel like that's where the financials really start to fall off, because we're
Yeah.
just constantly putting out fires.
100%. And it's perhaps even more important in the trades than it is in a sort of manufacturing business or a law firm or something, because you guys operate on such thin gross margins, right? Every job, if it goes south, like, you lose a lot of money fast. It's so important to watch every penny for those businesses and make sure you're profitable on every single job. Really careful with your overhead, all that sort of stuff. So I think you're right.
Yeah, the big thing we focus on is our labor hour management, because not only is it expensive for our labor hours to be paid, but every hour of labor, we have the truck, the fuel, the equipment, the
Sure.
overhead. I mean, the list goes on and on. So when you go over on labor by a day with a 3-man crew, that's 24 man hours. And you start adding that up, 150 an hour, you lose a lot of money in one day.
What I see a lot of the times is people estimating their jobs at an average wage rate of X and then performing their jobs at an average wage rate of Y being higher than X. And then they don't realize, like, oh, we're hitting our hours, but we're losing like crazy on the job because we're paying the people in the field way more than we're estimating the job for.
Yeah. And I think it's more important again now than ever because of the economy that we're dealing with as well. I mean, with interest rates where they are, borrowing costs up in the high 8s, even I've seen lines of credit renewed at 11%. We were at 4% 2 years ago. We've got a whole different environment on growing a business and how to think about taking on the right jobs, not just any job, and lots of different stuff that I think tracking becomes really important when we have this volatility.
Absolutely. And Matt, thanks so much for that background too. For our listeners, one of the reasons I want to bring Matt on, and Matt and I actually met, it's been about 6 years. He spoke to my CEO of Peer Group Vistage. And for those listeners who listen, you guys are seeing a theme. We've had a few speakers from Vistage on, and Matt talked about wealth creation. But what really piqued my interest was, Matt, you're an entrepreneur by spirit. And I think you understand the entrepreneur mindset, which is very kind of sporadic and difficult to manage. But you talked about this idea of wealth creation and building upon your wealth, because as entrepreneurs, specifically in the trades, the majority of our wealth is tied up in our business. I mean, it's 80 to 90% of our balance sheet, of our personal balance sheet. So I'd love to jump into this topic of personal wealth creation and how do we really grow that as business owners and entrepreneurs?
Well, I mean, you said it absolutely right, and I'm not any different from you, Justin. I think at least 80% of my net worth is tied up in my business, and it's easy to say, let's dump everything in there. But I think as we start to grow a successful business, we've got to be mindful of a little bit of diversification. But then it's like, well, do I want to spend time on my business or in my investments? And I think the answer is you want to spend time on your business, because that's where you're going to get the biggest bang for your buck. That's where all of your, 8 out of 10 of your eggs are in that basket. You better watch that basket more than you watch the other two. And so that's where I really advocate for diversification and really trying to automate your personal financial planning and personal investing so that you are diversifying, so that you are safe, but that you're still focused on a day-to-day basis on the thing that's really providing you the maximum wealth provider. Because let's just take a $10 million revenue business, right? If you can move the margins by 1% on a $10 million business, you added $100,000 to the bottom line. 1% margin change is 100 grand. Oh, and then you go to sell that business and you're selling it for, I don't know, just conservatively 5 times earnings. You just made $500,000 by focusing on a 1% issue. You can't do that in the stock market. You can't do that in real estate.
No.
But the antithesis is also true. I mean, this interest rate environment, I'm seeing a lot of trades the backlogs are starting to slow down. A lot of construction projects on hold, whoa, what did I heard us saying the other day, to stay alive until 25.
People are so tight with their pockets right now. So I have a couple comments there, like from someone who sells to these trades, people are becoming a lot more tight pocket on spending money on software. When you explain to them, it is 1% cost of your business on average. As someone who works for a larger organization, we spend 3% of our total revenue on software to support our business. But people are still trying to comprehend this, 1% of my total revenue being spent on software. And it's like, no, we can't do that right now. We can't, they can't see the ROI, which I do understand because there's so many pressures coming from outside their business that they can't influence, and they can influence if they're going to sign a contract for software or not.
So it's interesting you say that, Maggie, because I think that is one of the things that entrepreneurs do really, really well and really poorly, me included, is that we're really good gut people. Like, we know our businesses, we know our people, like we can manage them, we can get shit done.
Yeah, on the Colby Index, the best entrepreneurs their number one quality is their quick start. Like, they're very quick at making decisions and standing by those decisions.
Yeah, and generally the reason they're successful is because they made a lot of good ones. The challenge sometimes when it comes to accounting and finance is the good decision isn't always that obvious. And you use the word, Maggie, ROI. And what I tell people is there's nothing expensive and nothing cheap. We get inside of our own heads as entrepreneurs and we think, oh, that's expensive. Why? Because I've paid $500,000 for it before, and now I'm paying $1 million. Oh, it sounds expensive. Yes, but your $500,000 was a waste, and the $1 million is going to provide $4 million of new income.
Right.
Oh, okay, that's different. And so I think what I've tried to do with myself and what I tried to coach other entrepreneurs on is use your gut as the first sort of filter, and then do the numbers, and then come back to your gut and play ping pong between the two, because ultimately the numbers won't lie to you, even though you might feel like, oh, I can't spend money right now. I gotta, it's tight economy. I can't spend money. If you gave me $1 and I gave you back 99 cents, I'm still, losing. If I give you $1 and you give me back $1 too, I'm winning.
I thought it was also really interesting from someone who's not a business owner myself. My husband is, but you talked about like just your investments, being able to set them and not worry about them. And I think that I resonate to that quite a bit because I work for corporate America. I have 3 young children. I have a lot going on in my life. I can't worry about where my money is invested. Like, I have to have somebody else paying attention to that because it's not my area of strength. I don't know my way around a spreadsheet. I could care less about all that stuff, but also, I like money. I like, nice things. And so I think that what you're speaking to is someone, whether you own a business or not, like just a financial partner to guide you in the right direction.
Yeah. Do you mean their personal funds or the money inside of the company?
They should be separate. Justin and I had a conversation before this that separating out for the business and the personal fund should be step one. Whether you're investing your personal money or your business money, you should be doing it smartly and using a partner to help you do it smartly.
There's so many points in there that are important. The first one that I heard you say is separating out your business finances from your personal finances. Okay, this is probably the number one mistake I see business owners make, is they don't actually know the profitability of the business because they load up a lot of the business with personal expenses. And look, I understand that there are all sorts of business expenses that we want to make sure are in our business for tax purposes. And I want to do that too. We want to take every legal tax advantage we can. But we also want to be careful to judge our businesses on their own 2 feet, because in that case, we are owners, right? We are owners who take risk, and we need a return on that in terms of our return on our risk and our investment. And we need to make sure that we understand that our numbers can't be clouded with a bunch of other stuff in there. Then in your personal finances, totally separate, right? Your personal finances need to be separate out as almost a hedge or a wealth building tool that's outside of the business, because this is a risky and volatile. According to the Brookings Institute, 1 in 12 businesses under 100 million fails every single year. 1 in 12. That's 8% of the businesses out there. You get 12 businesses in a room, one of them's going to fail that year. That's super risky. So we need to be moving money out of the business as a hedge on these things.
Yeah, I think you can get really focused on keeping all your money in the business because you're seeing that return on invested capital. And you're like, man, I can't get a return anywhere else like I'm getting in my business. However, I think what you're alluding to is there is this happy medium where you can continue to grow wealth outside of the business. And you mentioned automating your investments and really diversifying your investments. I want to get into that because in today's world, we're hit with so many different things. Like we've got crypto, we've got Dogecoin, we got all this crazy shit. And then we've got, like the classic S&P index funds and some of these other things that have been around for decades and have really nice proven returns year over year. So when it comes to that wealth creation outside of the business, let's talk a little bit about that, Matt. And what's your approach on that when you're working with an entrepreneur?
I'll take it into kind of threefold. I'll tie it to the business style. So the first thing is you've got a plan for cash coming out of the business. Most entrepreneurs like us are in pass-through entities, S corps, LLCs, things like that, where the profits pass through to us and we pay the tax on it. So one common mistake I see with business owners making is using the cash that is not their cash. It's the IRS's cash. I live here in California. The IRS in the state of California are going to take more than 50%. I think my tax bracket's like 51%. 51% of those profits are not mine.
I'm grateful to live in Missouri. That's all I'm going to say to that comment.
But think about that for a second. If you make $1 million, you can't spend $1 million because half of that has to go to the government. So I believe very, very strongly that every single month, business owners need to be allocating their profit distributions that they will pay so that they can make their quarterly estimated tax payments once a quarter. And they need to set that aside. Don't believe it's your money and don't spend it. I made this mistake. Okay. It was 2003 or 2004. My business was growing. All of a sudden, my CPA was like, "Hey, Matt, guess what? You owe 250 grand." I don't remember what the number was, but he's like, "You owe something like 250 grand in tax." And I was like, "Where's that going to come from? I already spent it. That's going to be a problem because, so you've got to first and foremost make sure you're disciplined around that." I think the second thing then is making sure you don't have excess cash in the business that's not earning anything. So I really advocated, particularly today's economy, sweep accounts, bank accounts that are sweep accounts. You're moving every bit of cash you can into at least a money market account, right? Into at least a money market account earning 5%. With a lot of businesses, they got $500,000, $1 million, $2 million sitting on the sidelines that they're not using every day. And that 2 million could earn them an extra 100 grand without actually having to actually work. That's pretty awesome. So that's the second piece. The third piece then is using a barometer to say, well, how should I take cash out of the business? And I use this metric called the current ratio, right? And a current ratio is current assets divided by current liabilities. Think about it as current assets are all the stuff that's going to turn into cash in the next 12 months. And current liabilities are all the things that are going to suck cash out of your business. So if you ever played with one of those things in the sand where you put the sand in the top and it filters the bottom like a sieve, you got to have more sand coming in than going out or you run out of sand. But at some point, if you keep pouring sand on there, the mountain gets too big for the tray or whatever, right? And so you use this current ratio as a low water mark if I need to make sure I don't run out of cash, and a high water mark to say, if I get above this, sweep the cash out in distribution to me, and then I'm going to auto invest it into something outside of the business because I'm clearly not using it in the business to reinvest. So those are kind of the three steps that I use to cash manage into the business and then get that cash out into your personal life where you can get some diversification.
Okay, let me just summarize those three because those are super great points. And you said cash multiple times, and I definitely want to, cash management is so important, cash flow, forecasting. But here you say step one is plan for cash coming out. And I totally agree. I've been stuck in that place where a lot of times, so your quarterly tax payments are typically based on your previous year's profits. So what we found is in years where we've had really low profits and then the next year we're making a ton of money and a ton of cash, we don't pay much in quarterly estimated. And then when April 15th comes around, or if you put your extension October 15th, you have that 200, 300, 400, whatever it may be in liabilities you have to pay to the IRS. And you didn't plan for that. So I think planning for that and having a metric, work with your CPA quarterly to figure out how much money did I make last 3 months, putting that aside. And then to that point, putting it aside is having a place where your money can make money.
Yeah.
And we made this fatal error last year we had a lot of money in the bank because we were really scared, COVID, all this stuff. We were like, we don't know what's happening. And so we got really cash heavy. And then we realized we were just losing money with inflation. Luckily, I have a great controller, and now we've got a sweep account, just like you said, Matt. So really, basically every week, we are moving money, and sometimes more frequently, into our money market account. So we can make that 4.5, 5, 6%, depending on where it's at that day. And it's a nice little return, but I don't think it's as much as I can get personally with an automated investment. So to your third point, having some type of ratio, whether it's I want X amount of cash on hand. I really like this current ratio where you take your assets and liabilities. And then, once you get you get ahead and you have a lot more as current assets and current liabilities, you start to pull cash out to balance it. Is there a current ratio and I don't want to say there's one size fits all, but is there a current ratio that you utilize that we can look at?
Yeah, absolutely. So I think it's really important to remember that the current ratio is going to be very different for every business. And the reason is because of the volatility. The higher the current ratio, you need a higher current ratio if you have a very volatile business. If you have like a super seasonal business, if you sell Christmas trees, you're not selling Christmas trees in July. So you got to withstand whatever it is, 10 months of nothing and 2 months of a party. That's the epitome of a very volatile business. Or if your business is very cyclical with the economy, you need a higher current ratio so that you can withstand that stuff. You need a lower current ratio if you're a subscription-based business. A SaaS business, Maggie, for example, needs a lower current ratio because you're getting recurring revenue every month and it's very steady eddy. So you can withstand a lower one. Banks will not lend to most companies if they're under a 1.5 current ratio. Most banks. So that's the starting bare minimum starting point. I typically say that somewhere between a 2 and a 3 is acceptable for most businesses. If you're, again, a super volatile business, maybe you need a 4, but that's probably the maximum. Remember, a 4 represents 4 times as much stuff coming in over the next 12 months as is going out. That's a lot. That's a very safe business.
And I would say in the trades, you have different businesses, like you said, subscription. So like landscape maintenance, where you're getting that nice subscription money, you're going to be a little more stable. But if you're a high-end construction business in Chicago, let's say, you've got 4 to 6 months, depending on the weather, where you're getting almost no revenue, and you're almost certainly losing money in quarters 4 and quarters 1. So you've got to really have a stable current ratio. So I think that's a great way to look at it and come up with your number that you're comfortable with. Now let's go to the next step. We got cash coming out of the business. Awesome. Like, where are we putting that? What's a good place to focus on?
Something you said earlier, I want to just relate it back to this. As you said, as entrepreneurs, we're kind of like, I don't know, you didn't use this word, I'm going to use it. We're a little bit like shiny ball people, right? And we see them. So I create systems and processes to stay out of my own way. Okay. So like this current ratio concept is one that I use for myself, and then I just distribute everything else above that so that I don't think about it. Because if I get into my head on it, I'll come up with lots of other reasons why I should or shouldn't do something. And I do the same exact thing in my personal investing. So every single month, I invest every month, regardless. Market's up, invest. Market's down, invest. Sideways, invest. Every single month, I'm putting money away in the market. And I have a very basic formula for my asset allocation, and it's 50% in the stock market and 50% in real estate. That's it. And I keep my house outside of my asset allocation. I keep my business outside of it.
How did you get to that 50-50 breakdown there?
I made it up.
Proven over time, results over time?
Yeah, I honestly made it up about 25 years ago, 30 years ago, and I've stuck to it. I have all index funds in the stock market side of it, all index funds, nothing but them. And I'm happy, Justin, to share them if you want to share them with your listeners. I'm happy to give you my index fund picks, but it's just index funds because I don't want to try to bet on mutual fund managers or hedge fund managers who Vanguard did this study 2 years ago. And it was like 87% of the mutual fund managers didn't beat their index on a 1-year basis. 92% didn't beat on a 5-year basis, and 96% didn't beat on a 10-year basis. I was like, well, why am I giving my money to them? I'm going to invest in the index and I'm going to beat 96% of them. I'm good. That didn't make any sense to me. So I just auto invest into that stock market investments. And it is large cap, small cap, it's stuff international as well as US domestic stock market. But I think I have 8 indexes in the portfolio, and I just let it ride. I look at it. I just don't look at it and say, I'm smart or I'm dumb. I've just created an automated system that I know if I do that over time, I'm going to be fine.
I love that approach, especially with today's media cycle and just this constant flood of NVIDIA stock and crypto's up and this and that. And you're just like, you shoot, shiny ball, shiny ball. So basic explanation. What is an index fund? And then what are your top 3 picks on indexes right now?
So an index fund is a representation of that index. So if we talk about the S&P 500, that's an index. The Russell 2000 is an index. That's the small cap index. The NASDAQ 100, that's an index. The MSCI World Index, there's all indexes. And these mutual fund managers tend to be in a certain style. And so when I say they didn't beat their index, what I'm saying is that style that they're adhering to didn't beat it. So if you're a large cap US growth manager, your benchmark is the S&P 500. That's the same, that's the index for that. And so when I'm using index funds, I'm truly just going after those funds that are in there. And so like the VOO is the Index 500, the Vanguard and S&P Index 500 fund. You know, that's a great one. Pretty simple. The QQQ, the NASDAQ 100, pretty simple stuff. These are the kind of things that you want to stay in, very basic things. And the reason being, we said at the very beginning, I'm working 60, 70 hours a week at least. I don't have time to mess around with anything other than 80+% of my net worth. Everything else, if I have a good bet, it's going to win over time. Maybe I'm not shooting the moon, but I'm winning over time. And it's amazing. You know, my portfolio is done in that mix since 2003. I've done an average of 15.3% with a 50% stock market and 50% in real estate.
So just some sharing here on my end. You know, Matt, you shared this philosophy with me and my Visage group in 2018, and I kind of grabbed a hold of it. And so I immediately set up a VOO index fund that I put my money into, and another index. So I have 2 indexes that I'm in right now. And it just makes it so simple. So I automate, like I have a certain amount of cash I want to hold personally. So I want 6 months of living expenses in cash in my bank, in my checking. Any dollar over that is going into these indexes. And then every year I want to buy a house. And I just started that model in 2022. And my first year, I bought an investment property in Idaho when I was still renting a house. So I was like, this is really important to get this real estate set up. Then last year I bought my personal house, which again, I just like you, I hold outside of my investment portfolio. But I am this year now looking for a rental property because now my indexes are like 75% and my real estate's like 25%. So I'm trying to consistently equate those two. And when I say real estate, I'm looking at the equity I have, right? Like what is the house value minus my mortgage that I owe? So just from experience, putting this into play, I was always like, I'm going to try to pick this stock or pick that. And it's just, you're never going to beat the index on a long-term 10-year basis. And I have good salary. I think most people listening are making money in their business today to pay for their day-to-day. So this really is more to pay me when I'm not working anymore, after I sell my business, and to give me that, or God forbid, we go bankrupt one day, right? Like you said, 1 in 12. So I just want to share that because I've literally used this myself and it's been great. And so I really encourage our listeners to think about it.
I think it's interesting too, Justin, because you actually bought your first real estate property in a time when a lot of people weren't buying real estate because of interest rates, because of a lot of things going on. And you've continued to stay with that mentality. Did you ever have hesitation about, just interest rates in general?
No, because like Matt said, in terms of markets high, markets low, it's just automatic. Like every year I'm going to buy an investment property because I have a certain amount of cash that I need to deploy. And I know that I'm going to deploy a certain amount into real estate. And then on the index side, on the stock side, it's a monthly buy basically. Yeah. So every month I reassess my cash situation, and what's over that certain amount, I go and I buy those indexes and do the transfer. It's super simple, super easy. And there's not a big decision making process behind it.
I just think it's something that a lot of our listeners probably need to hear. It's like this, it can be, money is very emotional. Like it can be such an emotional thing. And like, and all these outside influences, and you stuck to the plan regardless of those outside pressures, which I've seen you do time and time again with K&D and with a lot of things. And I think some entrepreneurs would be scared by the outside pressures, but your success has proven to the fact that you set a plan and you worked the plan.
Yeah. And Matt, what's your take? So let's say someone's, just kind of getting started financially. They don't have enough. They can't afford to buy their own house, let alone an investment house. how can they get into some type of real estate backed investment? Is there any other opportunity out there that you would potentially suggest?
Yeah, absolutely. So you're going to invest in your stock market stack in a brokerage account. You can buy a real estate index fund to represent that at the start. I still vehemently believe that you want to own real property over time. I know we've all know really rich people that are real estate investors, and we also know really rich people who are stock market investors. And I believe they both do really well over time. I don't know which one's going to win in the long run, but I know that they'll both be worth more 15 years from now than they're worth today. So like you said, Justin, just every month put it in. And then once you build up enough capital in that real estate investment fund, go buy your first piece of property.
If you're thinking about buying a property, and like for us, right? We live in California. Buying a property here is really almost impossible for your first investment property. There's so much out there in this country that you can look into. And so I would just say, don't hold yourself back to your geographic area that you're comfortable with, or places you've traveled. I mean, your investment property probably isn't going to be a place that you go and you visit on vacation. It's going to be some, random town you've maybe never heard of, but there's an investment opportunity there. And again, like that's a whole nother set of rules around that, but real property is definitely the way to go when it comes to real estate.
I agree with you. And over time, I think you got to do that.
Yeah. And one more point. I know this is probably people know about this, but just one thing in California and other places, as rent has increased, your mortgage is locked in. So if your mortgage is $5,000 a month, let's say on the high end, and you're renting that property out for $4,000 a month, you're not making money day one, but over the next 20 years or 30 years, that $5,000 a month is remaining the same. And I guarantee that rent of $4,000 is going to continue to climb well above that monthly fixed rate of the mortgage. Now, as you've invested into properties back into maybe early 2000s, has that played true for you?
Yeah, absolutely. And in California, we have Prop 13, so our property taxes stay the same as well. That's not the same in every state. It is the way it is in California. But real estate, you want to look at it in a three-pronged investment approach. One is you've got to get a rent off of it of some sort, right? That's really, really important. Two, it needs to appreciate. Real estate in this country appreciates at around a 4%, 4.5% rate per year over time. Over long periods of time, that's about what you can expect. So you should expect a rental rate of about 6% of the value and an appreciation of around 4%. That gives you about 10%. But the third and the sort of hidden benefit is you get depreciation. So largely all of your income is sheltered from tax. And so that's the other big benefit that real estate provides that stock market investments can't provide.
And you get a return, not just on the invested amount, but the total value of the property. Also a huge benefit. So you got rent, you got return, then you got depreciation. Yep. Okay. So we're setting ourselves up pretty well here. We got 50% going into index, which based on your experience, right? We can't say this is going to happen in perpetuity going forward, but you're looking at somewhere around a 10 to 15% return over the course of a decade or two. And then on your real estate side, you're getting this 10% return between rent and the value creation of that property, the appreciation, and then the depreciation of it, you're offsetting those gains. So we're setting ourselves pretty well. Is there anything else that you would say, just like basic rules of personal wealth that you'd like to share with anyone?
I have 3 general rules that I really preach to anyone who will listen. Rule number 1 is don't spend more than you make. So spend less than you make.
It's so funny. I have a lot of young employees, and the amount of times I've said that to them, like, don't spend them more than you make, and don't spend it until it's in your bank account.
It's such a simple concept, but the discipline it takes to do it is real. It's not something that, you got to be smart about it. Rule number 2 that I have is invest the difference. So Justin, just like you're doing every month, brainlessly, do not think about it. Put the money away because you will worry. And by the way, we are going to have a recession. It's fine.
Oh, yeah.
And rule number 3, if you do rule number 1 and number 2, you'll be wealthy. But rule number 3 is know where you are and know where you're going. And what that means is know where you're spending your money every month. Take a look at it. Like I said, I don't believe anything's expensive and nothing is cheap. But there are things that give you ROI and things that don't. Whether it's software, Maggie, to your point, or, I guarantee you there are things you've done, spent $20 on that you wish you'd just taken a $20 bill out and lit it on fire because it would have been way more interesting. And then there were certain things you spent $2,000 on that were like, oh, wow, it was like the best thing I've ever done in my life.
Right.
Do more of the 2000 and less of the 20, and you'll have less stress in your life. As long as you spend less than you make, get personal ROI out of your expenses. Take a look at it. Really understand where you're spending the money and stop spending on things that don't give you value and keep spending on money on things that do. And then have a target. Like that's the goal where I want to go. Know where you're going. So you have a target net worth out there that says, okay, this is where I want to be in 10 years, 20 years, 30 years. And you'll be amazed at the compounding effect and how it gets you there.
Their comment on value is really important to me because I think that also a lot of people define value differently. Personal example for myself is everyone's like, I can't believe you spend nearly $40,000 a year in daycare. And I'm like, I can, like, because the value that I'm getting out of that daycare is incredible. Like people probably spend $40,000 a year on sports cars or, you know, what they define as their value. But, you know, there's this ROI side of things. And then there's also this just like personal value, like how we value things differently in our lives based on our situation.
Is it worth more than I spent on it? Is the 40 grand of daycare worth 50 grand to you?
Right.
It's so easy to spend money today. You can literally like tap your phone twice and you're spending money. So I think it's really important we do review those monthly statements that your credit card sends you that we throw in the recycling every month and just ignore on the email because we have it on auto pay. I think today's, as our generations get, you know, a Generation Z's coming in, I mean, I don't want to say they, like, I'll admit to this. It's very often that I don't really look at my financial statements from my credit card and I'll just spend money and I really don't know where it all went. When you start looking at that, you create a budget, you try to stick to it, and you review where you spent your money that month. And then, Matt, to your point, you ask yourself, what gratification and value did I get out of that spend? You're going to find out that there's a decent amount. I don't know what the percentage is for you, but it's probably between 20 and 30% of that spend was completely wasted. There was no value creation. It's a subscription you didn't use or something else.
Oddly, I just looked at this morning for myself. I use Quicken for this, and it makes it super easy because I've got all my credit cards in it. My bank accounts, I go, bing, push a button and look at it. And yeah, I found a subscription that I was like, do we need Disney Plus? What was the last time we looked at Disney?
Maggie needs a great investment for me, Matt. Like Disney Plus is not coming off my credit card.
No, that's what I'm saying. But this is a great example, right? Disney Plus for you is worth every penny, right? For me, I was like, I haven't watched anything. And so it's just interesting what we find valuable. And by the way, I'll put it back on, you know, when it's appropriate. But I think those are the kinds of things that you can easily have death by 1,000 cuts in your personal expenses.
Feel like people will buy the fancy shiny new truck all the time. Blink of an eye, I want the you know, the nicest looking trucks on the street. Oh, but I'm not going to spend the same amount for software that's going to run my entire business, or, you know, employees and different things like that. There's so many wasted costs in business. It's just astonishing to me once you start opening up the books and like looking at things that why do we have a line on our budget from losing mowers into the pond? Like that's an acceptable behavior. Let's fix the behavior and not lose money on mowers into the pond.
That's a good one.
The real one. I literally sat with a landscape company one time when we were deploying Aspire. Funny, like true story. They had $15,000 a year budgeted to losing mowers into ponds. They're in Florida. It's a regular practice down there.
It's a regular practice in Florida. They probably just jack them up. And like they got big tires on them and they've got a ramp that actually goes into, they're trying to jump the pond.
Yeah. Well, and we all know you're not going in the pond to get that mower in Florida because you don't know what's waiting for you in that pond.
I think to that point too, it's like, where are you not spending money that you should be investing? And I think we can get into that point of like trying to save every dollar everywhere, which is important to manage your spend. But also it's like, why aren't we spending any money on Google traction if all of our leads are coming from Google and we're getting beat by, you know, the guy down the street who's spending $2,000 a month on AdWords, but they're killing us on marketing. So I do think there's an area of spend that is like, we really need to be spending more money in certain areas.
Yeah, I agree. You just got to track it and make sure you're getting ROI on it. That's the thing. I think anything you spend money on, you should be getting whether it's hiring new people, you should be getting, you know, every one of us in our companies, we have to put more into the company than we take out. If we don't, the company will go out of business. That's just the way it works. And same thing with software. It's same thing with, but you can't cut your way to success. You can't be like, oh, you know what, I'm just going to cut all these expenses. Then you got to be able to provide your service and provide it at a profit.
At a profit. That's huge. And I think what you just said, we've got to put more into our businesses than we take out.
Mhm.
And as we start to grow the business and you go from that 1 million mark to the 10 million mark and beyond, you start to kind of feel like you're owed something from your business. Like, I put my time in the business, it's time for the business to pay me back. But I think you can get into a really dangerous situation where you are depleting from the business quicker than you're putting back in. So that's something to watch. That current ratio is a great ratio for that.
Yeah, the times when I've really blown it in business are the times when I got complacent. The current business that I have, TGG, we have a lot of ups and downs. We always have problems. We've generally been growing and growing and growing. We're 170 employees now. So that part's been good. But there were times, so it was 2012, 2011, and I remember it very vividly because we had our first big pop of success and it was getting a lot of traction. We were doing really well and the quality was starting to fade really fast. And I was sort of, I was working less. I was less involved with the clients. I was less involved with the service delivery. And I was on a summer vacation in an RV. And I just remember very vividly being like, I'm not doing this anymore because I saw us start to lose money. Yeah, revenue was going up and our profits were going down to the point where we were actually losing money. And I said, this is not happening. What's going on? And I dove into it and our quality sucked. It was all over the map. There's no systems and processes. Everybody was doing it their own way. And it's just accounting. It's not supposed to be done that way. And I created a TGG way. Like that summer, I wrote a manual that was basically, I called it the TGG Way Bible at the time. I'm like, this is what we're doing. And this is how we do every step of the business. And this is the quality that we're going to get. We have a 100-point test. And we still use that. It's been updated a bunch, but we still use that to judge quality. And the minute I took my eye off the ball with quality, it just went sideways. And it took me about 6 months, 9 months to realize it.
Commend you that you did realize it in 6 to 9 months, because I've actually seen business owners who it would take a lot longer than that, and just like owning up to it and fixing it. So that's great. And do you think that one small change changed the trajectory of your profit?
Oh, not just change the trajectory of the profit, it changed the trajectory of how I felt about the business.
That's
So
good.
I don't know about you guys, but as a business owner, when somebody tells me that we've done a bad job of accounting, like if I hear that from a business owner, it hurts me personally. I feel it. It's like they told me I'm a bad guy. I know I didn't do it. I'm not the accountant doing work, but man, it hurts me. It didn't just change the trajectory of the profit of the business. It changed my stress level. And by the way, we lost 35% of our employees within 3 months. They're like, we're not doing this. We got our own way of doing it. I said, okay, that's the door. It happened like that. And what was amazing is our profit turned around in 60 days.
Yeah.
We went from losing money to making money in 60 days. It turned around like that. And it just, but it took a lot of pain for me to be able to wake up from the complacency that I was in, because we were making a lot of money and doing really well. And reputationally, we were great. And I just took my eye off the ball and said, okay, cool. I don't have to work so hard.
Wow. And so, Matt, are you the CEO today, or do you have a CEO in the business?
I'm still the CEO. I
Okay.
have a great management team in place who largely runs the day-to-day. I still am involved in a lot of the day-to-day, but I'm involved more at the strategic level. So where are we headed? What are we doing? How can we constantly improve the business service delivery? That kind of stuff, as opposed to like running a team or running clients or things like that.
I think that's such a great share. Thank you for sharing that, because sometimes we get to the point where we feel like our businesses are kind of running self, and you're like, I can step back. I can go on vacation for a week or a month or 2 months. And it sounds like, from your experience, and I'll share mine too, is like, the more you're in the business, the more passionate you are, the more you share that vision, the better your team is going to perform. And service delivery is so important. And profit is a great key performance indicator to your quality and your service. So it sounds like when your service went down and quality went down, your profit followed very quickly.
Mhm.
And then as soon as you fix that, your profit rebounded really quickly too.
Yes. Again, nobody will pay me to do accounting unless I can provide more value than I'm costing them.
That's a great, ROI. And same with Maggie's software. If it costs more to utilize the Aspire system than we are making in profits from that, then there's no reason to stay on it.
I try to tell everybody to make ROI decisions. And your accounting department, by the way, this is something that I think people don't fully appreciate, but we preach this inside of our program all the time. Your accounting department should be a profit center for your firm, not a cost center. They should be finding ways for you to make money.
Right.
Finding things like those Maggie, the unnecessary expenses you're talking about, implementing software and efficiencies so that the percentage of revenue in the accounting department costs go down, not up. But, oh yeah, we spent 1% on software. Cool. But our old accounting costs were 4% of revenue. Now they're 2%. Oh, we made 1 net. That's good.
And the trades, the number one controllable cost is labor. And what we found is just the unnecessary amount of overhead labor costs, just the extra accounting values to put receipts in, or to answer the phone and deal with client issues and all those sorts of things. Like adding a software efficiency tool reduces overhead costs just by bodies. And some people get really scared about that because like, oh, am I going to lose my job, or are we going to get cut? No, if the business gets more efficient, the business can grow and you become more valuable to the business. They're not going to just say, oh, we don't need you anymore because we have streamlined this one process.
It's going to happen. I mean, look what's happening in the fast food industry in California.
Right.
You've got one of 2 choices. You're either getting more efficient or you're closing your door. That's it. And if you look at what McDonald's has done, it's pretty remarkable. McDonald's over the last 4 years has doubled their average hourly wage in the US. How many businesses
I did not know that.
literally double the average hourly wage of their personnel and still make money? They not only made money, they improved their gross profit margin by 4 percentage points. Their prices have gone up too, so that's a part of it. They used to have an average of 8 people per store. Now they have 3. Their target is to go to 1. Okay, they're automating cheeseburger making, fry making. They're automating all the order taking on the apps on your phones, right? They got in a little bit of trouble in the Wall Street Journal. I read this article because they were memorizing your license plate so that they could like figure out what you wanted to order before you even ordered it.
That is
With
getting
the
a
3
little
kids
too
meals.
creepy. Yeah, with the
And
kids meals and the extra fries and the car seats.
Well, what's funny is they got in trouble because they were doing it based on a license plate. And what they've done is they've just done it based on credit card now, which is apparently not illegal.
Wow. Oh my gosh.
But they know, like, that's why everybody's moving to the app so they can track what you order, because they realize the faster you get through the drive-through line, the more efficient it is, the better their gross margin gets. And so you're seeing, like, when we were kids, it was like Happy Meals, the latest movie toys, so you could get the kids there so the parents ate. You had playgrounds and stuff. They're doing away with all that.
Oh, 100%.
Mm.
And I'll give you an example as why, because I do go to McDonald's at least once a week to get my kids meals. They have I use the app. My entire order is memorized, but they also put things in front of me. Like they don't want you to buy Happy Meals anymore, because what that does is creates more boxes, more time for them to box everything up, more wrappers and everything. Instead, they're putting in front of me like a cheeseburger pack where I can get 20 nuggets and all these things. And I'm like, I'll just get that. It's cheaper and I can break it up between all my kids. Like they're really getting smart and efficient with these things. Oh, and by the way, if you get this, we'll give you 25% off your order.
Yep. They're very, very good at this. And you go, oh, they must be killing unemployment. Not killing unemployment. Doing the opposite. In every instance in history, whether it was the Industrial Revolution or the cotton gin or whatever, software thing or whatever you want to talk about, it hasn't decreased jobs. It's increased jobs. It's changed the type of jobs. Nobody really is excited and wakes up going, I want to flip burgers today.
We do the same thing in the landscape industry. I mean, when I was selling maintenance contracts, I would sell them for was a margin cheaper if that mower didn't have to get back on the truck, the blower put away, the truck closed up and moved from property to property. If they could ride on that mower 2 doors down and mow the next house, of course you're going to get your job cheaper. Like we do the same thing, and that's why GPS. I could not preach this. I know we did a whole episode on GPS, but like not only from a safety standpoint and a dash cam standpoint, but just like the GPS efficiency of knowing where your crews are at, and when you're in a pinch, you can move things around and just save efficiency from that standpoint. I mean, I cannot preach it enough.
And the McDonald's price, the hourly wage doubling in the last 4 years, right? We're in a similar type of inflationary environment in our trades industries.
Yeah.
And we're seeing the wages go up and up. And I am totally in favor for that. I think it's long overdue. I think our technicians need to be paid better. I think we need to maybe charge a little bit more, but if we can help them make more money and get more efficient, then everyone makes more money and the customer ends up happier because we're there for less time interrupting their house or their home or their family or their commercial space. I mean, people don't want to see the landscaper out there. They just want the grass to look good.
Right.
And so the quicker we can get in and out, the better. So Matt, I think this is just a trend we're going to continuously see as we go forward, and knowing your numbers is going to be key to that.
Look, I think what you said is spot on. We can pay people, everybody can have a better quality of life, and we can get things done in a much more efficient way so that it's less costly for everybody.
Yeah. All right. Well, we're going to end this episode like we end all of our episodes and ask for your trade secret. So what is something you'd like to share with our listeners that you've just inherently learned over time, Matt?
My trade secret is compound interest. So this is something that I've really learned to embrace in all aspects of my life. If you think about compound interest, you think about money, but that's only one aspect of compound interest. If you think about relationships, the more you put into them over time and do it consistently, the better the relationship gets. If you don't do it consistently and you let like years go by, that's not compounding interest. You have to do it consistently. You think about like fitness. If you want to go work out, you really actually can make progress. Do a lot less that first week and then just keep doing the same thing, and that benefit compounds over time. And so I think compound interest is my trade secret. It's obviously not a secret, but it's what I have learned is had the biggest positive impact on my life.
Thank you for that. That's a great share.
Yeah.
That's a great secret.
It's a great share, and it's something I'm going to take back to my team because, I have a lot of people joining my team right out of college and stuff, and they don't understand the importance of investing early, saving your money early, and paying off your high debt early. I mean, I actually had one person come to me and say, yeah, I mean, student loan interest is at 0%. So I'm paying off all my student loan debt. I'm like, what are you doing? So I think that just that compound interest is a great example of just something I can take back to my team and teach them on. So I appreciate that.
Matt, thanks so much for being on today. Really appreciate it. A lot of great share. I think we're going to get a ton of value out of this. So appreciate you.
Awesome. Thanks for having me, guys. I appreciate it. It was really nice, and I had a great time.